Here we are, SMF, MMTs. This is the S&P 500. Once again, you're below that long bull 200-day moving average. We clearly said that we were going to go that level. Your beautiful summer rally that started here on the S&P went straight back up. The long-term reversal here, straight up. But that high reversal was lower right here than this one. And this one was lower than that one. And now you're breaking that 200-day simple moving average, and the jobs report's going to come out on Friday. What it means is that the bigger trading desk and people are petrified, terrified that you're below it because they thought they had it made. No. GDP at 1.3%. Consumer spending down. The ISM numbers that came out yesterday were horrible. What started that rally was an ISM and a PMI number, economic, and they, whoop, bam. But look at the longer term cycle of movements in our trade management. Once we got here was to sell everything when it made the intraday high, and the top down selling trade would be, the short would be in play. And how right we are. And not only are we right, we're proud of it. And we're proud of the work that we've done with our MMTs and teaching them about all the various different aspects of how market internals work. Many things outside of the box that people choose not to look at. But once again, going long and going short, that's what we do. So every day's a good day for us. But right now, that bull is probably pretty miserable right about now. And just to let you see right here, if you don't think they're miserable, they are. And the S&P is going to come down to a major psychological level right here. This is where we had that one rally to a 52-week high early in the year. Go to stockmarketfunny.com. We had that first correction, then we had that blow off top. Then we had the long-term correction from that blow-off top to a summer rally that we traded and shorting that S&P below the market as we did the work on the put options of what that 1260 put would look like. But the neckline at 13, we were looking at that way up here. Way before any of that could have happened, because that's how you make money. And as you see the selling continue, with your debt ceiling that was just passed and all the hurrah. Boy, what a Playhouse 90. They took that thing right to August 2nd. Today is August 2nd, 2011. ADP report will be out tomorrow ahead of the unemployment on Friday. And the thing about it is, it suggests in the ISM number that unemployment is not getting better, meaning that people aren't going back to work. Because if they were, that number wouldn't have been the way it was, and it's going to show a contraction. All the analysts have come out, threw in the towel finally. Instead of listening to us, they decided to be bullheaded and thought that they were going to have 3.5 to 4% GDP growth, and the second half of the year was going to be the most wonderful year. They're all coming out today and downgrading the third quarter. The phantom ghost is the fourth quarter. Oh, boy. What about that? What about Ben Bernanke making you pay higher at the pump when he goes in his QE3? All of these things have consequences, and they're consequences to our wallet. And the thing about it is, the economy needs to stand on its own 2 feet and go through its processes, and the White House and all of this social stimuluses need to come to an end. They need to come to an end, because that's not the answer. It never has been. We have proven that over many bear markets, and you know how these expansions with taxpayer money always end up failing miserably. At whose expense? My expense, your kids' expense, and everyone else around you. Pay a price for policymakers to manipulate the capital system. Monetizing debt is not a way to go. However, they will try to move people out of the safe haven. That 30-year bond is the one to watch. That's going to be the key, where you'll know if that QE3 is going in there. That's where the Treasury buys it up every day, moves people out of the safe haven back into what? That risk on trade, those risky asset, that risk. And that's coming. But the problem is, every time they do these things, there's a price to pay. Forward looking from now, in 2013, there'll be a huge price to pay. So, the S&P has a daily sell signal. The long-term trend line right here, where we broke higher to the first 2011 high, to the second 2011 high, and we are in correction one there, the long-term correction here with that little bull rally, but we're starting another one right here. And that the constructive part with your public little chartists that think they know everything, they don't. They don't know how to identify from here to here or here to there. They just talk about what it is. The trade management is that we're going to get short-term oversold on the S&P. And what does that look like? When we were here in the last rally, percent DS was at 93%, and we said, hey, that's the end of it. I'm sorry. But when we were over here at 11%, it was time to be long. We were oversold. Right now, as of today on 8/2, you're coming down to oversold levels at 16.60% DS, standard public analysis, where people start to make decisions. Okay? So, trading the dog days of August and that jobs report is by this breach right here. This is a little bottom of the original part, but this is the trend line that counts. And it's the first sell through below the 200-day moving average that the S&P has broke. That means that the long-term bull trend, because you know, a bull trend is a bull trend, and that green line was rising all the way over here. But look at, by the time you get triggered in over here, you've already missed a big piece of the move. That's what happens with standard technical analysis. It lags the price. So I'm going to pull this part of the chart up so you can see that long-term rising bull green line, the 200-day moving average, is being broke. That's going to put some of the bigger people on the sideline until Friday. How do markets price in future-looking events? Is that we have the daily sell signal. We're below the 200-day moving average. We're going to come down, and that number that comes out on Friday is not going to be very good. But how does a market price in the event, and how do you trade the volatility of that jobs report on Friday? Yabba dabba doo. The selling is increasing. You're at 1262. You're coming to that key psychological area over here. And you are. And the bull is getting taken to the woodshed in the SMF. Short sells are working their glory. We will take a look and see what happens here as we price in the volatility for volatility bounces. But just remember, within the volatility structure, when we bounce up, and we do bounce up in volatility, upside volatility price action, it will be sold short. That's what we've been doing for ever since we got here, and ever since we got there on an intraday level with the equities that we make markets on, is that has panned out. And each and every one of those live entries and live exits and live trade management is all on the stockmarketplenty.com website, because it is. So, like I say, don't be a sucker, but get paid a lollipop. And this is how you get paid that way, and this is how you get paid this way. But it takes training. It doesn't come easy. And no one says that it does come easy for a retail trader or retail investor. No, it does not. But it is the land of opportunity and market volatility cycles, both bull trends and bears. The long-term constructive has been broke, as it has. And what that means is that we will hit an oversold area. We will bounce up for a long trade when that time comes. I didn't say it was right at this moment. No, I did not. But I said it will be here. and it's right around the corner. And remember that we will be taking a look at the put to call ratio on the S&P. So when markets are putting in a short-term oversold area, the put to call ratio, just like the calls were totally inflated during this whole thing, and the puts were the cheapest trade to be on. But back over here, the calls were deflated, and now the puts are going to get inflated and the calls will come down, and we will be monitoring and training the MMTs on how markets gauge using short-term put to call ratio scenarios for short-term market volatility turns. However, the damage on the daily chart, which most people look at, and I'm sure you'll have 1,000 opinions out there, but when it gets down to it, at the end of the day, it's all about trade management now and how that trade management is going to work. And we do all of this before the fact. It doesn't do you any good when you're coming to the conclusion down here, but what about what the conclusion was in the first long multi-year reversal, week after week after week? Look at 1, 2, 3, 4, 5. Look at 8 days in a row. 1, 2, 3, 4, 5, 6, 7. I'm sorry. 7 days in a row. No, there's 7 days in a row. But let's take a look at it. Each day we were selling short into the move. You see the wicks? They pop up, they go down. This is where the problem started. It tested, sold through the key moving averages that you see. 50-day, 100-day, 20-day, 10-day, and finally the ultimate 200-day moving average. Short term, we will get to a point where we get oversold and we'll trade volatility on the S&P 500 using index call options at the right time as they take all the premium out within market upside volatility, downside volatility, upside volatility. The upside volatility will be bought and sold immediately, because you're not just going to go straight down. There will be a counter trend at some point from an oversold condition with a double daily sell signal. Wow. Here's where it bottomed out last time when we were putting the bottoms over here. This is called a moving average convergence divergence. And by the time you get a buy signal, you already missed the rally. Ha, ha, ha. That's what your standard readings do. So people start, getting all involved up here and getting all bullish. Yeah, it's a daily buy signal, so what? But how much of the move does the public let go by, or the retail trader go by the time it signals a buy signal? No, you got to know how to buy over here. And that's what we do. And this is how you sell short down. Okay? Remember one thing. A lot of people talk after the fact. Anybody can do that. What good's it going to do you? Doesn't do you any good. Understanding declining daily moving averages and declining 50-day moving average, that white line is not flat. It's starting to descend, and you're crossing over the 10-day, over the 100-day. This is the beginning of a major turn. Upside volatility will be in play. This is the dog days of August. Jobs report is coming out Friday. Right now I'm at 17.2%. When I was over here on the S&P, I was at 11.13%. So there's still a ways to go. This trend line is going to be major right here. And like we said, if we break it, well, then we will use our platform to come up with the prices where the S&P 500 will go. Enjoy the short squeezes, the bull raids, the bear raids, trade management, and how do you walk away with a better life.